So in a market where consumers are completely cash-strapped and, inflation is just eating into corporate margins, almost every legacy brand is desperately pivoting to e-commerce.
Right, yeah.
But a brick-and-mortar store that sells discounted clothes off metal racks just saw its stock jump over 4% in a single day.
It's a completely remarkable counter-narrative. I mean, you look at the broader landscape in late summer 2026, and the expectation for physical retail is really just survival at best.
Yeah.
Yet here we have an off-price retailer completely breaking the mold.
Welcome to this Market Pulse Daily Deep Dive. Today, our mission is to unpack an absolute monster of a quarter from ROST Stores, ticker symbol ROST. We're looking at a stack of sources, including a highly detailed, forward-looking equity research report and market data through August 21st, to really understand what is happening under the hood here.
And before we get into the Catalyst stack, just a quick note for you listening, you can check out the StockOracle 14-day trial link right in the description.
Definitely check that out.
Just keep in mind, we are affiliates, so AI insights and value estimates might be wrong, and the data could be delayed. And as always, we only use this applied research here. No buy, hold, or sell financial advice. We're just looking at the facts.
Exactly. We're just breaking down the data. So following their second quarter earnings release, the stock spiked 4.39% to close at $239.04.
A massive jump.
So the central question we really have to answer for you today is this massive surge just like a temporary windfall from bargain-hunting consumers feeling the macroeconomic pinch? Or are we looking at a durable, compounding growth engine that can just keep running?
To figure that out, we have to look closely at what actually changed, the underlying mechanics of their revenue, because the headline numbers they just posted, they represent a fundamental shift in how the market is valuing their execution.
Well, let's get right into the scale of this Q2 earnings beat, because it is wild.
Yeah.
The second quarter of fiscal year 2026, ROST reported revenue of $6.26 billion.
Which is huge.
Yeah, that is up 13.3% year over year. But the real shockwave was the bottom line. Their earnings per share, or EPS, came in at $2.66.
Yeah, they absolutely crushed their own internal guidance. I mean, that was sitting way down at, what was it, $1.85 to $1.93?
Right. And that kind of outperformance doesn't just happen by accident.
No, not at all. What really stands out to me in the data is the comparable store sales. They surged by 10%.
And to see comps surge by 10% right now is, it's staggering.
It really is.
Consumer credit cards are practically maxed out across the broader economy. Discretionary spending is supposed to be incredibly tight.
Right, which means a 10% jump isn't just them relying on opening new doors to mask stagnant sales.
Exactly. They're squeezing 10% more volume out of their existing, already paid-for physical footprint. That implies massive foot traffic and, heavy basket sizes.
It proves that the treasure hunt merchandising model, it actually thrives on macro anxiety.
Oh, that's an interesting way to put it.
Yeah, when consumers feel the pinch, they become aggressively value-seeking. But what makes Ross unique is how they fulfill that need. They don't just sell cheap clothes.
Right.
They sell the psychological thrill of finding a high-end designer jacket for $40, just mixed in with everything else.
I'm really glad you brought up the mechanics of that model, because it is crucial to understanding why they are winning right now. Ross basically acts as a pressure release valve for the entire apparel industry, right?
Precisely. Think about it. If a major department store cancels a massive order because of a sudden shift in consumer trends,
Which happens all the time.
all the time, or if a premium brand overproduces a specific line, those brands need to liquidate that inventory quickly to free up capital.
Right, they need the cash.
And Ross has an army of buyers ready to swoop in with cash, buy that premium inventory at pennies on the dollar, and just disperse it across their stores.
So the customer gets the designer jacket for a fraction of the cost. The premium brand gets some cash back without cheapening their primary retail channels.
Yeah.
And Ross captures the margin in between. It is a brilliant arbitrage of supply chain inefficiencies.
And importantly, it creates a variable reward schedule for the shopper, because the inventory is constantly turning over based on whatever excess stock Ross managed to buy that week.
You never know what you're going to find.
Exactly. You never know. It trains the consumer to visit frequently. That psychology is what drives a 10% increase in same-store sales, while other retailers are watching foot traffic just evaporate.
But I actually need to pump the brakes here and look at the fine print for a second.
Okay.
Because when you dig into this catalyst stack in the research packet, there is a hidden asterisk in their future guidance that kind of threatens this whole rosy narrative.
Ah, the tariff refund.
Yes. Management raised their full-year 2026 EPS guidance to a range of $8.61 to $8.77.
Which is a very aggressive raise on the surface.
Right, but the sources explicitly note that this updated guidance includes a $1.60 per share tariff refund.
Yeah, that's a one-time government windfall.
Exactly. So I have to push back on this massive valuation jump. Like, is this massive growth story actually an accounting illusion? Are they just masking average retail performance with a tax-like refund check?
Skepticism is entirely warranted here, especially when a one-time item inflates the headline guidance. It makes the earnings look artificially muscular.
Right.
But let's actually stress test the underlying business by doing the math without that crutch.
Let's run the numbers.
So if we take their massive Q2 ETS of $2.66 and we entirely strip out that $1.60 one-time benefit,
We're left with an underlying organic EPS of roughly $2.06.
right, and consider the context of that $2.06. The company originally told Wall Street that their absolute best-case scenario for Q2 was $1.93.
Oh, wow. Okay.
Yeah, so even if you erase the government refund entirely, the core retail operations still comfortably beat the top end of their own estimates.
And so the momentum really is real then. The treasure hunt is genuinely converting at a higher rate than even management modeled.
The operations are fundamentally outperforming. However, that tariff refund does shift the burden of proof going forward.
How so?
Well, by raising the full-year guidance on the back of a one-time refund, ROST has set an incredibly high bar for the remainder of the year.
Ah, gotcha.
In the coming quarters, they have to prove they can generate double-digit comps organically without any external padding.
That makes sense. And if the core business is genuinely pumping out that much cash, we have to look at their capital allocation strategy, because this is a massive part of the catalyst stack.
It really is.
Looking at the operating cash flow in these sources, it's wild. In Q1 alone, their operating cash flow reached $836 million.
That's more than double the previous year.
Exactly. And they are just hoarding this money. They are deploying it in two very aggressive ways to drive shareholder value.
The first being physical expansion. Management accelerated their plans for 2026, bumping up their target from 110 new stores to 115 new locations.
Which feels incredibly aggressive for a brick-and-mortar chain right now. I mean, most legacy retailers are actively shrinking their footprint.
Oh, absolutely. They're closing underperforming stores to optimize for like an omni-channel approach.
Right. But Ross is sprinting in the opposite direction,
Yeah.
just pouring capital into physical real estate.
They're doing it because the unit economics of a new Ross store are incredibly favorable right now, especially with commercial real estate softening in certain areas.
Yeah.
But the second way they're deploying that cash is perhaps even more impactful for the stock price.
The massive share repurchases.
Exactly.
They bought back $319 million worth of their own stock just in Q2, and they are on track to buy back a staggering $1.275 billion for the full fiscal year 2026.
Let's break down why this is such a powerful financial mechanism for you listening. Imagine you and 9 friends own a massive plot of land together.
Okay.
Each of you owns a 10% stake. If the group uses the land's profits to buy out 2 of those friends and retires their deeds, the physical size of the land hasn't changed at all. But your personal ownership stake just jumped from 10% to 12.5%. You suddenly own a bigger piece of the exact same profitable asset.
So by constantly buying back stock and retiring those shares, Ross is systematically reducing the total number of shares in existence.
Yep.
And every remaining share lays claim to a larger piece of the company's earnings, which mechanically inflates the earnings per share over time.
And here is the critical detail from the balance sheet that makes this strategy bulletproof compared to other retailers.
What's that?
A lot of legacy brands tried to buy back stock in the 2010s by taking on massive amounts of cheap debt, which eventually became a trap. Ross is doing this with their own cash.
Right, the net cash position. There was a slight gap in the raw SEC filings provided in our packet, like total liabilities weren't explicitly itemized. But looking at their debt profile, they have about $4.1 billion in cash and equivalents against roughly $1 billion in total long-term debt.
Right, giving them a net cash position of over $3.1 billion. They're completely flush. They are self-funding a 115-store expansion and a $1 billion buyback program without straining their balance sheet at all.
It is a beautifully constructed financial flywheel. The business generates cash. They plow that cash into building more stores, which generate even more cash, and they use the excess to buy back stock, making every remaining share intrinsically more valuable.
It is.
But we can't just look at the bullish, rosy side of the ledger. If we want to truly understand this investment profile, we have to look at what could reverse this momentum, what could break this flywheel.
The vulnerability lies in the expectations baked into the stock price. The market reaction has been huge, but that comes with a cost.
Yeah, the valuation is where things get genuinely tense. ROST is up over 64% in the last 52 weeks. It is currently trading at a 33.62 trailing 12-month PE ratio.
That is steep.
For anyone keeping track, you are paying nearly 34 times their past year's earnings to own a piece of this company. Analysts in our reports are openly asking how much track is left, and several are actually maintaining hold ratings based purely on this valuation.
Right. They aren't saying Ross is a bad business.
No, not at all.
They are saying it is a prohibitively expensive stock because when you trade at nearly 34 times earnings, you are priced for perfection.
Yeah.
The market is assuming your execution will be flawless for years to come. But if you look at their margins, flawless execution is incredibly difficult to maintain.
Let's talk about those margins.
Their gross margin is 28.09%, and their net margin is a very tight 9.74%.
Okay, I want to push on that for a second. A nearly 10% net margin doesn't sound apocalyptic for a discount retailer. I mean, they move high volumes at low prices. Why are analysts getting nervous about a 10% margin when that is kind of standard for the off-price sector?
It's standard, yeah, but it makes the company incredibly vulnerable to reverse operating leverage.
Okay, unpack that.
Let's look at how fixed versus variable costs work here. Ross has massive fixed costs that do not change regardless of how many items they sell. They have to pay the rent on all those 115 new stores, they have to keep the lights on, pay their corporate salaries, and run their massive distribution centers.
Those costs are locked in.
Locked in tight. So if your net margin is only 9.74%, that means out of every $100 in revenue, you're only keeping about $9.74 in actual profit after all those fixed and variable costs are paid.
Right.
If macroeconomic pressures like inflation cause your labor costs or operational expenses to rise even slightly, those fixed costs become an anchor. A 3% increase in operating expenses doesn't sound like much, but it eats up a massive chunk of that $9.74 profit.
So a tiny percentage increase in their massive supply chain can wipe out a huge percentage of their bottom line.
Let's take that a step further, with a specific risk management flagged in the source's freight costs.
Oh, this is the big one.
Think about the math of a shipping container. If a luxury brand ships a container full of $3,000 handbags, the cost of that shipping container is a microscopic fraction of the retail value inside.
Obviously, yeah.
But Ross is shipping containers full of $10 t-shirts and $40 clearance jackets.
So the freight cost makes up a drastically higher percentage of the final retail price.
Exactly. So if global shipping rates spike or fuel costs surge, it disproportionately hammers an off-price retailer's margins compared to premium retail.
Wow.
Because they only have 9.74% of wiggle room, any resurgence in inflation or freight costs will drastically hurt the bottom line. And remember, at a 33.62 PE ratio, the stock price requires that bottom line to keep compounding perfectly.
That is a phenomenal breakdown of the risk. They are executing a masterful tightrope walk, but because they are priced for perfection, there's absolutely no safety net if the macroeconomic winds blow the wrong way.
None at all.
Which brings us to a really fun part of the analysis. Let's look at the blue sky scenario. What happens if several important catalysts line up positively?
Yeah, let's look at the optimistic future based on the data we have. And just to be clear, this is an optimistic scenario, not a prediction.
Right, of course.
If all the favorable conditions hold true, if bargain traffic persists and they maintain even mid-single to double-digit comps, and if they successfully integrate those 115 new stores using internal cash and relentlessly execute that billion-dollar buyback program.
But financial flywheel just spins faster.
Exactly. Ross will structurally compound its EPS year after year. It would validate the high PE ratio by proving they are a durable growth machine.
And that would easily justify the $280 price targets that are currently being floated by analysts at Citigroup and Bernstein in our sources.
It absolutely would.
But obviously we have to stay grounded in the immediate reality checks. For you listening, we want to give you 3 specific things to watch going forward.
The first test, the next major event, has to be their next quarterly earnings release, Q3.
That is the show me quarter, right?
Completely. Remember the tariff asterisk we discussed?
The 60 cents.
Yeah. The market knows that $0.60 per share refund is baked into the full year numbers. The single most important confirmation signal in Q3 will be whether they can deliver those high double-digit comps and maintain their 9.74% net margin entirely on their own.
If Q3 shows organic momentum, the market will breathe a huge sigh of relief.
But if Q3 looks sluggish, investors will assume the Q2 beat was mostly an accounting illusion.
Okay, what's the second thing to watch?
The upcoming holiday selling season in late 2026. This is the ultimate confirmation signal for the value-seeking consumer thesis. Can they deliver massive holiday volumes while successfully navigating the freight and labor inflation that management explicitly warned about?
A strong holiday comp de-risks the entire thesis.
Exactly. But if they have to aggressively discount their already discounted items just to move inventory, reverse operating leverage will crush their Q4 profits.
And the third thing is really the main risk signal, right? The freight and labor inflation itself.
Yes. Keep a very close eye on any broader economic reports regarding shipping container costs or domestic wage inflation. Those are the direct threats to that tight 9% margin.
To bring this all together, ROST Stores is an incredible case study in capital allocation. We're looking at a masterclass in how a deceptively simple business model, selling excess apparel inventory on metal racks, can become a relentless financial engine.
It really is.
It is not a glamorous software platform. But when a management team allocates massive cash flow perfectly between self-funded physical expansion and share buybacks, it creates compounded wealth that just defies the broader retail apocalypse.
It proves that operational discipline and a deep understanding of consumer psychology can still win in physical retail, provided you manage your margins with absolute precision.
And that leads me to a final provocative thought I want to leave you with. It is something we haven't touched on yet, but it is glaringly obvious when you read through the entirety of this research packet.
Oh.
In the sources we reviewed, there is absolutely zero evidence of Ross investing in e-commerce.
A complete absence of digital strategy.
Exactly. There's zero mention of them launching new digital banners, building out an online marketplace, or trying to expand internationally through the web. In a world where every single legacy retailer on Earth has spent the last decade desperately trying to become a digital tech company, Ross is stubbornly, entirely reliant on the physical, in-person store. You have to physically walk through their doors, grab a cart, and dig through the racks to get the deal.
Because you cannot replicate the variable reward of the treasure hunt algorithmically.
Right. You can't scroll on an app to find that jolt of adrenaline when you unearth a $40 designer jacket hidden behind last season's sweaters. You have to show up.
Yeah.
And it makes you wonder, in an era where consumers are overwhelmed by digital targeted ads and infinite online scrolling, could Ross's stubborn refusal to go online actually be their greatest competitive moat?
It forces engagement in a way Amazon never can.
It really does. It's something to ponder the next time you are out running errands and you walk past one of their 115 new storefronts. Are you looking at a dinosaur holding on to the past, or are you looking at the one species that figured out exactly how to survive the asteroid?
That's a great question to end on.
All right, well, that wraps up today's deep dive. Don't forget to check out the StockOracle 14-day trial link in the description. Thanks for listening, and we'll catch you on the next one.